All right, let's get right into it. Today, we're tearing down the third quarter 2025 earnings call for the Latin American fintech giant New Holdings. Now, they put up some seriously impressive numbers, but the way the market reacted, well, that's where the real story begins. Let's dive in. So, right off the bat, the headline numbers looked great. New reported earnings per share of 17 cents. That was a solid beat over what Wall Street was expecting, which was only 15 cents. But this is where things get a little weird. You see a company beat earnings by over 13%, and you expect the stock to, take off, right? Instead, we got a collective shrug from the market. The stock closed the very next day up just under 1.5%, barely a blip. And that really brings us to the big question we're tackling today. Why? Why such a lukewarm reaction from investors after such a strong beat? The answer, as it turns out, isn't in that headline number. It's buried deep inside the details of the call. So to really figure out what's going on, we got to look past that EPS number and pop the hood. Let's get right into the engine room and break down the key metrics that were really powering the quarter. First up, just the sheer scale of this thing. Newest customer base is now a staggering 127 million people. I mean, just think about that. They added over 4 million new customers in just 3 months. And they're keeping them engaged, too, with an activity rate over 83%. This isn't just some app anymore. It's a massive financial ecosystem. And it's not just about getting more customers. It's about making more money from each one. And that's exactly what's happening. Average revenue per active customer, what the pros call ARPAC, it just crossed the $13 mark, hitting $13.40. This is proof their monetization engine is really starting to fire on all cylinders. Okay, now for what I think is maybe the most important number of all when it comes to profitability, return on equity. New hit a record 31% annualized ROE. For any bank, let alone one that's still in this crazy hypergrowth phase, that is just an exceptional number. It's a huge flashing sign of a super efficient and incredibly profitable business model. And look, the good news wasn't isolated. It was a clean sweep. Revenue came in at $4.17 billion, beating the $4.03 billion that was expected. Net income hit $783 million, a jump of 39% from last year. This just shows fundamental strength across the entire business. Now let's put this all into perspective for a second. How is New doing compared to its peers? Well, over the last year, while the rest of the fintech sector was actually down 6%, New was up over 12%. I mean, they are absolutely crushing the competition in what's been a really tough market for fintech. All right, so we've established the quarter was strong. Let's shift gears now and talk about where management is steering the ship. The big theme from the call wasn't just about the numbers today, but really about the technology that's going to drive them tomorrow. CEO David Velez couldn't have been clearer about this. He said New is moving to become an AI-first company. Now, this is not just some corporate buzzword. He's talking about completely rebuilding the bank around their own AI models, going from just using AI to being fundamentally AI native. This is the absolute core of their strategy for the future. And that AI strategy, it's really the top of 3 major growth pillars. Right alongside it, they're pushing super aggressively to scale up in Mexico and Colombia. And then there's the third pillar, which is all about creating these huge long-term opportunities, like applying for a U.S. bank charter and their new partnership with Amazon in Brazil. These are the engines they're building for the next 5 years of growth. So, if the results were so good and the vision is so clear, what were the analysts worried about? What were the tough questions? The Q&A session really shined a light on the key debates that are probably responsible for holding the stock back, at least in the short term. The first major topic was net interest margin, or NIM, which got squeezed a little bit. Now, there are really 2 big forces at play here. On the one hand, the cost to borrow money in Brazil is going up. But on the other hand, and this is key, New is deliberately shifting its loans towards safer, higher quality customers. Now, those loans have lower interest rates, but they also have way lower risk. So you have to understand, part of this pressure on NIM is actually a strategic choice they're making to improve the quality of their loan book. And that leads directly into the second big question from investors, credit quality. Management's message here was basically, don't worry, we've got this handled. They said delinquencies are right where they expected them to be. And why is that? Well, because of that shift to safer borrowers we just talked about, because their new AI models for underwriting are working really well, and because they're just getting better at collecting on defaulted loans. They really painted a picture of a portfolio that's resilient and very well managed. Okay, so that's the full breakdown of the quarter. Now it's time for our analysis looking forward. Based on everything we heard on that call, here's our take on what you should expect leading into the next one. First, just so we're all on the same page, let's define our terms. We're going to assign an equity research style rating. When we say outperform, it means we expect the stock to do better than its sector or the overall market over the next several months. Simple as that. So what should you, as an investor, be watching for? Here's the catalyst map. In the very near term, it's all about the Q4 results. Then, as we get into early 2026, we'll want to see the first real numbers on how that Amazon partnership is working out. By the middle of the year, a huge milestone will be hitting profitability in Mexico. And then looking further out, any news on that US bank charter application could be a massive game changer for the stock story. So let's put it all together. Here's our final thesis. For the fourth quarter, we're predicting that New is going to keep up that incredible 30% plus ROE while also continuing to get more efficient. For the stock itself, we think you're going to see a gradual climb as the market slowly starts to wake up and price in the huge long-term potential of their AI and US expansion plans. For all those reasons, we are assigning an outperform rating to New Holding.
And as always, a quick reminder, this is not financial advice.